Good morning, good afternoon, and good evening, everyone, depending on where you're joining us from. I'm delighted to welcome you to today's panel discussion. Today, we're focusing on how climate shock inflation dynamics, and their consequence for central banks and monetary policy, especially in the context of inflation targeting framework. So you all know that physical hazards such as droughts, floods, or heat wave can have consequences that driving up cost of essential sectors like food and energy. At the same time, transition policies such as carbon tax or carbon trade schemes can also have an impact on inflation. So today, these impacts have been generally short-term, but as climate intensifies and the transition accelerates or become more disorderly, the magnitude and the persistence of these inflationary pressure can increase. And this poses difficult question for central banks operating under an inflation targeting frameworks. And to help you unpack these challenges, I'm pleased to be joined by a distinguished panel of experts who brings deep experience from both policy and research perspective. I will introduce them in the reverse order of how they will speak. So let me start first with Elías Albagli, who is a director of the Monetary Policy Division at the Central Bank of Chile since 2018. And over the past decade, he has held several key positions at the bank, including director of research division and manager of modeling and economic analysis. So his earlier experience include roles as senior economist and economist analyst within the bank economic research division, as well as several positions in academia. So Elias has taught extensively on financial markets, macroeconomics at leading Chilean universities, and he currently leads a seminar on planetary limits and economic development, if I'm right. Thank you for joining, Elias. We're looking forward to hear you. Our second panelist is Alexander Matthias Dietrich, a research economist at the research unit at the Denmark's National Bank. His work focuses on monetary economics, household expectation, and survey methods. Alexander's currently explores the dynamic of inflation expectation and the implication of climate change for monetary policy. So right on the topic of this seminar. And last, thank you for joining, Alexander. And last but not least, a colleague from the Center of Economic Transition Expertise at the London School of Economics, Luis Pereira da Silva, who served as Deputy General Manager at the Bank for International Settlements from 2015 to 2023. During this tenure at the BIS, he also took on key leadership role as acting chief risk officer, chair of diversity and inclusion committee, and chair of the environment and sustainability steering group. He's one of the author of the Green Swan, which is kind of a key cornerstone or publication for the BIS on climate. Prior to that, Luis was deputy governor at the Central Bank of Brazil. He held senior position at the World Bank across Washington, D.C., Tokyo, and Southern Africa. And his extensive public service also includes roles as a chief economist at Brazil Ministry of Budget and Planning and deputy finance minister for international affairs. I hope I don't forget anything, Luis, and that I didn't mistake the titles. It's a pleasure to have you. You just published a paper with David Palms on climate change and inflation targeting, and I would like to start with you to present us with your thoughts and your conclusion on how climate change can impact the inflation targeting for central banks, and what are your policy conclusions, basically. Thank you very much.
Thank you very much, Pierre. It's a pleasure to be here in this seminar with Alexander and also Elias. Let me share with you a short presentation about this issue of how central banks should be dealing and concerned with the effects of climate change on their inflation targeting monetary policy frameworks. Can you see the presentation?
Yes, we can see it perfectly.
Okay.
Thank you.
So this is based on the policy paper I wrote with some colleagues at the LSE. It follows a bit the reflection that we had, as you mentioned, in the Greens one. Bottom line is what does climate change for inflation targeter central banks? One thing we know is that we are facing more frequent and more persistent supply shocks. There is a lot of literature and empirical evidence showing that there is more inflationary pressure coming from physical risks related to climate change. And we believe that the literature also shows that the supply risks are dominating the risks of negative demand shocks. Now, if you are a inflation targeting central banks, you do not really worry about classical supply shocks, right? You just basically look through them and accommodate. But the problem that we're facing with climate is what about if these shocks are more frequent, bigger, and more persistent? In a sense, it would be like the reversal of the China effects during the Great Moderation that facilitated quite a bit the slowing down and the maintenance of inflation at a relative low level. Do you really continue looking through, or do you do something about this? And the issue for IT central banks is how do you really keep the large benefits of IT, and we should recognize them, with changes that have to do with the regime, but you don't want to lose the credibility of the IT regime. So first, the recognition that these persistent supply shocks will indeed affect inflation worldwide. This is a picture of what will happen under some classical scenarios of the IPCC for food inflation and headline inflation. I think we all suspect that they will have an inflationary pressure, right? They will sort of, because of extreme weather events, because of heats, they will transmit first, for example, to food inflation. These are the sort of darker, more red spots in the two globes that you see in this picture. And these food inflation pressures will transmit naturally into headline inflation. So it's a significant impact, annual impact, and if you want to report this to Europe, this is the impact of food inflation under a sort of a more optimistic scenario or a more pessimistic scenario of transmitting weather events, climate events into food inflation. You can see that the transmission is inflationary, and it goes from, let's say, in 2035, 2060, about a 1% higher food inflation, but it could also be, in worst case scenarios, up to 2% higher food inflation. Now, mind you, this is about, if it reaches 2%, it's about the center of the target of many IT central banks. On top of that, if you want the countermeasures to fight climate change and you introduce carbon taxation, which is a good thing to shift the carbon footprint of our economies, you can see that the studies that I'm showing here for many countries like European, but also the US and China, they point to a effect or the transmission of carbon taxation, particularly disorderly carbon taxation, again, being a good thing, but certainly causing a rise in inflation in the next and the following years. If you also look at the other solution, which is not carbon taxing, but introducing new technologies, you have here a picture that is at the same time good news and bad news. Good news because the price of these technologies that we can use to engineer lower carbon footprints in our economies is falling, as you can see on the right. The price of EVs, batteries, solar panels in generating new electricity sources is falling, but nevertheless, there is a cost for using these new technologies, and unfortunately, at least for the time being, these technologies would have also an inflationary impact. Now, if you go a bit more on a sophisticated path, which is to use the traditional new Keynesian DSGE models for monetary transmission of the energy changes, these are the kind of results of a exercise done by Fornaro and others for a DSGE featuring a two technology world, dirty world and clean world, brown and green. And if you shock the model with a policy instruction restricting the production of brown technology, you have, of course, an inflationary impact when precisely you use more green technology. And then you compare the results in terms of two types of regimes for central banks. A regime where a central bank would be more protecting employment, or a regime where you conduct a standard inflation targeting policy reaction to this this regulatory change. And you can see, I mean, it requires a bit of a further explanation, but we can discuss this further, that if you use standard inflation targeting, you would get actually, by tightening the monetary stance, a reduction in incentives to invest more in green technologies. And even if you sort of allow the model to behave in a reaction function that is standard, you will have, of course, a system where if you tighten the policy to react to the higher inflation produced by the regulatory change, unfortunately, you have less growth, less productivity in the green sector. So basically, what do? You are a central bank. You target inflation. You're still committed to your 2% target. Should you really look through, as the classical policy response tells you, or should you tighten monetary policy? I think we realize that the trade-off is between accepting a bit more inflation vis-a-vis sacrificing a bit more of sustainable growth. So option one, you do nothing. You look through, but you are a bit dovish in terms of your policy rate reaction. And this might imply overshooting the target repeatedly. It might imply de-anchoring inflation expectations. It might imply a loss of credibility and therefore eventually higher inflation and perhaps higher probability of financial crisis. Option two, you react classically because you want to tame inflation, but you are hawkish in terms of this inflation produced by climate change. You stick to your current 2% inflation. You might tighten monetary policy, but that might be a bit in excess for producing or at least hampering the green and sustainable investment. Therefore, you have more sluggish growth, and you might slower the green transition with a welfare loss. So the discussion in the paper is to essentially propose a reflection, a revisiting of the IT regime to adapt itself for a precisely world with higher temperatures, and climate change effects. And there we compare what is the classical response of the current IT regime vis-a-vis something that we called an adaptive inflation targeting regime. It's pretty much the same, but with a difference in terms of the way you see the target and the way you see accommodation bands. So essentially, what we propose is a reflection. It's not something that has to be done lightly, that you can choose between having keeping the same 2% point target. In emerging markets, it could be a bit higher, but the principle is you keep the same target, but you have accommodation bands precisely to allow the effects of climate change into your headline inflation. Or the other option is that you have perhaps a higher point target with smaller accommodation bands. We also think that it's useful to think about the horizon, because climate change would propagate to a bigger, larger horizon than the current 1.5, 2 years of most central banks. And therefore, the idea is to make sure that we don't lose the advantage of IT regimes, but we accommodate them or we adapt them to these pressures that will come from persistent, larger supply shocks. So in conclusion, we think that we already recognize that climate change is bringing these more persistent, larger negative supply shocks. We think that central banks that adopted IT regimes need to realize that and discuss the response. Maybe tightening could become excessive and exacerbate the downturns and maybe not favor the transition. Now we need to be very, and this is the final message, very cautious in this. The IT regime, as we know, is built around credibility. So we cannot change the rules without losing credibility. And my suggestion in the paper is to discuss these challenges only when inflation and expectations are anchored and on target. Second, you have to coordinate this discussion in circles where central banks are represented as a community, for example, in the BIS, and it cannot be just an opportunistic change just done by an individual central bank facing these challenges, because it undermines certainly its credibility. And this is particularly something that central banks in emerging markets have to think about. So in other words, to finish, the problem, I think, is real. It's a permanent or persistent larger supply shock. IT regimes are equipped to discuss these supply shocks in normal times, but with climate change, they need to think about a slight temporary adaptation of the target or accommodation bands because of the effects that we are observing, and that can undermine, if nothing is done, the credibility and the efficiency of IT regimes. And I stop here. Thank you, Pierre.
Thanks a lot for the introduction. So already a lot of key questions and fundamental questions for central banks. I just want to signal that if you have questions after the presentation of the panel, you can already type them in the Q&A section, and I will try to relay them to the panel in the discussion. But before that, I would like to turn to you, Alexander. So you have a model, you have done some research that highlight a bit the effects that Luis just described. So if we'd be happy if you can present that, and then also maybe at one point give or in a second round, give your feelings about the proposition that Luis just highlighted at the end of the presentation.
Pierre, thank you very much for inviting me to this panel. Yes, so I'm presenting a very recent research paper that is closely linked to the ideas that Luis just discussed from his paper. And in this paper, we are focusing on the household side during the green transition, and focus there especially on the role of monetary policy. I have to say, of course, the usual disclaimer applies. This is just my personal opinion and not the opinion of my employer. To set the stage for this paper, in the EU, we now have an emission trading scheme that covers a lot of carbon emissions, but so far, the household sector has been excluded from this emission trading scheme. But from 2027 onwards, with the ETS2, there will be explicitly an inclusion of household carbon emissions, and that affects mostly durable consumption of private households in the euro area, usually reflecting transport and building related CO2 emissions. So say, for example, cars or heating systems that rely on fossil fuels from 2027 on, they will be subject to a CO2 emission tax. And the idea behind that is, of course, that in the long run, if you raise the price of burning fossil fuels to households, they will gradually start switching to greener alternatives, say an electric vehicle or electric heating system for their house. You might ask, where does monetary policy come in here? During the transition phase, there emerges a trade-off for monetary policy, because those green durable consumption goods that we actually want households to consume more of via this tax are very sensitive to interest rate changes, usually because a lot of those cars or heating systems are financed by consumers. So for the decisions to buy those goods, interest rates are highly relevant. And so when this tax will be introduced, we simulate in a model that it will first and foremost lead to consumer price inflation. Consumers have to pay this carbon tax, so their inflation will go up. And monetary policy can now stabilize this inflationary effect in order to keep inflation at target by raising its nominal interest rate. But ultimately, doing so will slow the green transition to some degree, because higher interest rates will curb the demand of consumers, especially for those green durable consumption goods, such as electric cars, for example. So there emerges a trade-off for monetary policy here between stabilizing inflation and assisting the green transition. Could you go one slide further, please? Thank you. So what we have done, we have designed a three-sector new Keynesian model. There is a non-durable sector and a brown and green durable sector. And we looked to the literature to devise a path for CO2 price emissions. This is based on expert forecasts for the price of CO2 certificates over the next years. And we gradually phase this price in the model to simulate that shock to the economy. And monetary policy can now react in two distinct ways. Either the central bank can target the headline inflation rate, that is the consumer price inflation index, and thereby raise interest rates quite strongly following the introduction of the tax. You see that in the top right figure by the red line. Or in a second simulation, we look at a case where monetary policy only focuses on core inflation, producer price inflation, and looks through this tax shock on the economy. And in the bottom left figure, you can now see that there we plot the durable consumption for green and brown durables for the headline inflation target relative to the core inflation target. And it's easy to see that under the headline inflation model, when central banks raise their interest rates strongly, durable consumption for both green and brown products declines by households because interest rates increase. But the effect is much stronger for green durable purchases. So those are especially affected by higher interest rates by the headline inflation target that we simulate here. And ultimately, this then maps into a trade-off for monetary policy. The bottom right figure tries to show this trade-off. As a baseline, we take the headline inflation target, which is denoted by this red dot. And then relative to that, we look at the core inflation target, where monetary policy looks through this CO2 price introduction. And looking through this introduction of the CO2 price comes at the cost of having slightly higher inflation for a couple of years. But at the same time, it has the advantage that the green transition on the horizontal axis here, the green relative to the brown stock of durable goods, is somewhat faster. So we might accept somewhat higher inflation, but therefore have the benefit of transition of a faster transition to the state where we want to be, that most brown consumption goods such as cars get exchanged for electric vehicles for green consumption goods. If you may go to the next slide, please. So, of course, you might ask, given that there exists this trade-off between the strict inflation target and a more secondary goal for the central bank, what does optimal policy look like? And we conduct a welfare exercise in our paper to look at optimal monetary policy. And that turns out that, consistent with a lot of the literature, it is actually optimal for monetary policy to only target core inflation, that is, look through those CO2 price shocks, and do not adjust interest rates to the CO2 price. So this trade-off is kind of resolved once we move to optimal policy. However, if we basically step outside of this model and look at real challenges, this of course comes at the risk, as Louis already pointed out, of de-anchoring of inflation expectations. We know from the literature that those energy prices, through which a lot of those CO2 taxes work for consumers, they are highly important for most households, very salient in their formation of inflation expectations. So we conclude here that even though it might be optimal to not target the CO2 price here, it is important to have a very effective policy communication with the public to keep expectations on target.
Thank you very much. So another angle of what Louise explained, with an emphasis on also anchoring of inflation. Before we go to the discussion, Elias, can I invite you to present your point of view from Southern Hemisphere? You're joining us from Chile, so.
Absolutely. Let me just share my slides. Great. Can you see the full screen?
Not yet the full screen. Yes, we can. Perfect.
Great. Let me bring out the. All right. Thank you very much, Pierre, for the opportunity to discuss these papers, which I believe are a great contribution to the literature on the consequences of climate change and the environmental transition more generally for monetary policy. Before I begin, I should mention that all my comments are my own and not necessarily reflect the views of the board of the Central Bank of Chile. These papers complement each other very well, and it was kind of challenging to discuss them simultaneously, but at the same time, I realized it's a very useful exercise because it forces you to see and emphasize the big picture issues that they raise rather than the specific details of the papers. And that's what I'm going to try to do today in my comments. The first paper that Luis presented is a comprehensive survey of the implications of environmental transition, both physical transition impacts on inflation. And while transition impacts are mentioned in this review, I would say the paper highlights mostly physical impacts. That was the impression I got anyway. Very importantly, as policy implications, as Luis carefully mentioned, the authors propose a more flexible monetary policy framework to deal with these new shocks, which they call the adaptive inflation targeting regime. In the second paper that Alexander just presented, the exercise is a bit different. The authors calibrate a DSGE model that has both brown and green durable consumption goods and use this toolkit to quantify the inflationary impact of the next round of emissions that will be included in the EU's emission trading scheme. In doing so, the paper evaluates the trade-offs that are involved with different inflation objectives, in particular, whether you use CPI or you use a more core measure that strips out some of the components that are likely to get affected with this new carbon prices. I would say, Pierre, that above all else, the papers that we heard about today suggest we might be at the outset of a paradigm shift in monetary policy in the following dimensions. First, the nature of the shocks that we will be dealing with in the coming years and decades. Second, the different analytical toolkits that we need to understand the implications of these shocks. And as a consequence of the above, we might also require different monetary policy frameworks to guide the decisions of central banks. So let me begin with the reviewing the first of these important shifts that I think that the authors of both papers strongly suggest. That has to do with the nature of the shocks. The papers we saw suggest that both physical and transition shocks are likely to be, simply much larger than what we're used to. But also, these shocks involve multiple dimensions. And more importantly, these dimensions are likely to play out simultaneously. And this is because, on the one hand, changes in climate conditions generally trigger many stressors at the same time. So you can have droughts in one region, floods in other parts of the world, and this might be playing out simultaneously. But moreover, as the physical impacts get worse, of course, countries are going to be more motivated to pass on legislation, transition policies. So we are likely to see all these things sort of build up on each other. Okay, so it's not only that the shocks are large, they are likely to play out simultaneously. And moreover, many of these shocks are likely to be anticipated to play out over extended periods of time. Now, this is kind of obviously true about transition policies. When there's a change in legislation, we anticipate there's a period of adjustment. But less obvious, but equally important, it might also be true about physical impacts. To the extent that we start understanding the earth science behind these shocks better, it is very likely that once we face a year of drought, say, this will lead to a different conditional forecast of the years that lie ahead. So I think it is also true about physical impacts that once we get hit with them, our forecasts of the coming years are going to change. And this is markedly different from the logic of DSGE models, in which we have an economy that's near the steady state and is basically hit with mostly unanticipated IAD shocks. Okay. In this slide, I borrowed one of the figures that I believe is in the paper by Luis and his co-authors. I found this picture quite useful because it helps us classify whether the shocks are predominantly physical or transition in nature, but also whether they are likely to be inflationary or deflationary. And here, let me just raise my own opinion on this. I think in principle, we can see shocks, populating any of these 4 quarters, okay? But in practice, I think physical impacts will be mostly negative and play out predominantly through the direct supply side effect. Okay, this is important because we see in the discussion that there are some other general equilibrium forces playing out once these shocks materialize. They involve, for example, precautionary savings and a decline in demand and so on. But I think just in magnitude, these second round effects are going to be smaller. So basically what really matters is the direct supply side impact of the shocks, of these physical shocks. And this will mean that they're most likely inflationary. Something similar is true about transition impacts. this was brought with more focus on the second paper. They are likely to be dominant through their direct impact on aggregate demand, and particularly in the case of green transition investments. Because of the sheer magnitude, we have a paper in the conference of the Central Bank of Chile a few years back, where we just put numbers, approximate numbers on the figures involved in green investments, and they're just huge. So they're most likely to be inflationary, and also importantly, they are likely to raise the natural rate of interest, which is not so much the focus of the papers, but it was mentioned at least in the paper by Luis. Let me turn out briefly to some of the challenges and changes this implies for our analytical toolkits. I think the authors are also quite persuasive in suggesting that the different nature of the shocks, as well as the different transmission channels through which they play out, require a rethink of both the data that central banks collect, as well as the models that we use to make sense of this data. In the slide, I included a picture from a recent paper that we participated in with some colleagues at the Central Bank of Chile. I won't go into any detail of this, but I just want to point out, and you can see this from the nature of the figure, that if you really want to understand the implications of different environmental stressors, you need to know the precise geolocation of where different stressors are likely to materialize. And after you know that, you need to intersect this map, this physical map, with a map of where firms are located, where their base of operation takes place in an economy. So yeah, the data that you need to do this analysis in a proper way is quite different from what we're used to. Fortunately, there are many earth science research institutions within many countries that are more than happy to help in filling these data sort of blind spots that we have. But this requires a proactive decision by central banks to build bridges of collaboration across different fields, particularly fields that we don't know much about, okay, and we're just learning. It is also immediate from this discussion that we need richer models in terms of the sectors they involve, the type of shocks they're faced with, and the transmission mechanisms that link sectors with different agents of the economy and so on. And here I just want to flag out that the NGFS is launching an ambitious second phase within its modeling subgroup to facilitate the adoption of these models across its wide membership. I'll be more than happy to talk more about the details of this if we have time and there is interest in the Q&A section. Let me just finish with perhaps the main kind of idea behind the papers we saw today. If we have a relevant shift in the nature of the shocks that we face, which I think we absolutely do, and this implies that we need a reassessment of the analytical toolkits with which we do our analysis, it is also very likely, and I tend to agree with the authors, that at the very least, we need to seriously rethink whether our current monetary policy frameworks are still adequate for dealing with this new reality. Now, just as the authors do, they mention this in their careful discussion, I want to highlight, and this is going to be my last remark, the role that monetary policy credibility plays as both a concern and eventually a limitation on how flexible this newly adopted monetary policy framework can be. On the one hand, we know that credibility is quite heterogeneous across the world. It's high generally in advanced economies, not so strong in emerging market economies. But the point I really want to stress that is perhaps less obvious is that if we take this into a timeline, we may be at a peak in monetary policy credibility. In the following sense, an important negative side effect of the increasing migration flows that we're seeing in the last few decades as a consequence of climate change has been the political polarization in many countries. And as we know, unfortunately, political polarization leads to the advancement of populism, and populism tends to crowd out good institutions. And among these good institutions, of course, we should include the independence and the credibility of monetary policy regimes. So let's be careful, if we inherit to future central bankers that are likely to be much more pressured, politically pressured in the decisions, with very, very flexible inflation targeting regimes, this might be the perfect recipe for them to just be more dovish in general, you know? So as a general message, I agree with the authors. I mean, the implications of their analysis, I think it's very natural that we need to rethink very hard on the changes that we need to do on our monetary policy frameworks. But let's try to keep these changes sort of manageable and hopefully linked to some very clearly observable triggers, you know, things that we can point out, like a huge, you know, food price shock across the world or something like that, that can lead, for example, to a sort of an escape clause. So say we have a very clear inflation targeting regime with clear parameters. We are faced with this very huge shock that is very, you know, easy for everybody to observe. And this triggered a transitory change in the parameters. For example, the period in which we allowed inflation to go back to the target, or the target itself, for example. I don't think we have the answer at this point exactly how we should change this inflation target frameworks, but I do thank the authors for bringing up these very important issues. And I'll stop here. Thank you.
Thank you very much. So as I said, the Q&A section is open for you, and I will try to relay. But before that, if you, Luis or Alexander, you want also to reply to Elias' warning at the end. I think it's the presentation shows that there will be pressure on the monetary policy framework. They might need an adaptation of this framework, but this framework has also built its reputation and its credibility over time. And we should think carefully about you know, how to make sure that credibility remains for central banks. And maybe I would like on my side to add another dimension, maybe to that is there were a lot of emphasis was also about credibility being reflected in an anchored expectation, or anchored inflation expectation. At the same time, Elias also said that expectation is anticipated. And if people or the economy start to anticipate higher inflation and or higher shocks, how does that play out with anchored expectation? And what kind of framework can make sure that you anticipate right, but you still anchored through monetary policy? Does someone want to start on this aspect? Luis, I see that your mic.
Maybe just to follow up, Pierre, on Elias and you. I think we all realize how important it is to preserve the essence of IT regimes, particularly its credibility dimension. And there, I fully agree with Elias that you know, we have to be very careful when we advocate or we flag the possibility of changing the center of the target or accommodation bands. And that's why one of the cautionary messages that I put there is that it has to be first a discussion. It's not a decision. Second, it has only to be in a situation where inflation is around the target and expectations are anchored. And second, we have to realize whether or not we believe that the tightening of monetary policy, if there is precisely a bump in inflation, would not hamper the needed investments for the transition. These are three conditions under which I guess we would be in safer grounds to reflect upon this. Last but not least, to do it collectively. This cannot be just someone or some central bank somewhere in the world raising the issue and changing its target just because precisely it has to accommodate higher inflation. This would be counterproductive. It has to be a collective decision, and if it is a collective decision, no better than the forums where the central banks discuss this, like the NGFS or the BIS, to do so. Now, I think to finalize, I think we all realize that we are now entering a period where we are going to be subject to something that is completely different, which is the shock, the inflationary shock of what is happening in the trade dimension of the world. So probably we, before we can sort of get a more serene way to discuss these issues, we will have to wait to see exactly what would be the result of the measures that are being taken on trade, so that central banks can begin reflecting on the climate IT regimes that are adapted to the transition, but without the noise that trade wars would be introducing and complicating things to ourselves.
Does anyone wants Alexander? Yes.
Yes. So Elias, thank you first of all for your comments. I very much agree with your conclusion that the more discretion we add to central bank decision making, the higher the risk will of course become that there will be political pressure on decision making, but also that expectations might de-anchor. So I think this has long been shown theoretically that there is this risk the more the decision is taken on a day-to-day basis, judging whether this is like a long-run supply shock or just a transitory one. The higher the risk becomes here that consumers might de-anchor in their expectations. So I think we have to be very much aware of this risk and be very careful in that dimension. Luis, if you may add to what you just said with the trade shocks, it's very similar to the trade shocks, and I've always been thinking about climate change in the future to also increase uncertainty, especially for businesses. There are a lot of risks, say natural disasters that may materialize in a year, they might not materialize in a year. So uncertainty levels might be going forward much higher than they have been in the past. How do you think about those issues in your framework?
And if I can ask also add to that in a sense, the type of shocks that we're now seeing with trade shocks, could that also lead to a ground to think about how central banks should react to these trade shocks, and is there similar questions in terms of do we need to respond or not? Is there similarities with climate change, for example? Is it, for example, a good moment to rethink about how central banks operate when we are in face of so much volatile shocks?
I think we all are a bit in unknown territory here about the magnitude of these tariffs, because it changes frequently, and the sort of the general equilibrium effect of these on perhaps a scenario where you would have an inflation surge at the beginning, but then we could end up with a recession at the end. So if that is the case, then the recommendation of treating at the beginning this as a temporary supply shock and looking through would apply. Now, we don't know. It might be that you might not necessarily have stagflation. You might sort of have a situation where you do have a more persistent inflation surge that would require the type of policy reaction to eliminate the transmission of these effects in the rest of the economy. So I don't think we can see this as a straight comparison with climate, because for climate we know that this would happen. Climate is something that will have, no matter what, an effect on food inflation, on headline inflation at some point in time in the, say, next decade or so. And the discussion we were having was about the way to react to this kind of a bump in the price level and inflation, say, in a period of 5 to 10 years, not mixing it with the current disputes about trade.
Elias?
Yeah, so thanks, Pierre. I would just like to attempt an answer to one of the issues you raised at the end, of the role of anticipating shocks and how do we deal with this and at the same time keep inflation expectations anchored. So I think this is one of the key points that are brought by both of the papers that we saw today. Okay, so imagine that we have a shock. Just to be more, it's perhaps easier to see it with a shock that implies a relevant transition impact. Okay, so if we have say a transition playing out in an economy for the next 5 years, and we think that this is going to raise inflation in maybe 20 basis points per year, I think this is something that we can kind of adjust without big changes in our policy framework. But if we're talking about a couple of percentage points, half our inflation target, for example, this is harder. And I think if we just say, no, you know what, no matter what, we'll keep inflation at, say, 2%, which is the goal of most central banks in Europe, then you are very unlikely to hit the target. And this is it's gonna be like shooting yourself on the foot in an anticipatory way, right? So I mean, there's not that doesn't make a lot of sense. Years ago we went back to the document that was the base for the monetary policy framework that we have in Chile. So we have a 3% target, a forecast target that we need to meet at 2 years' time, and it's exactly 3% in a forecast. And the logic behind it is basically the second moment behind the 95% of the shocks that we face. 95% of the shocks that we face, take care of themselves, to the extent that they're supply shocks, with very little reaction of monetary policy in a period of 2 years. So you don't have to do much. And if there are demand shocks, of course, you have to counteract them. So it's just standard monetary policy. But the 2-year framework doesn't come out of the thin air. It's because it meets the volatility of the usual shocks that we face. Now, if that volatility changes, or if now we have shocks that we anticipate that will last 3 or 4 years and they will have a relevant impact on inflation, well, that's when we have to rethink our frameworks, because the origin of the framework is really a statistical, exercise. If the distribution guiding these shocks changes, well, it just follows that we should announce and we should have these escape clauses in our monetary policy frameworks. I think that's much better for preserving credibility, saying, look, guys, for the next 4 years, we're going to do an escape clause because of this important transition policy, than trying to meet them and, every year failing and trying to give explanation. That's going to be much worse for eroding credibility. Thanks.
I'm trying also to sum up some question in the chat. When you think about rethinking the inflation framework, could that, for example, also lead to rethink who is involved in inflation reaction? So should fiscal authorities be coordinate with central bank, or could you also think about rethinking the toolbox that central banks are using? So there are propositions to say that if, for example, a high interest rate are penalizing the transition sectors, you could have like a refinancing operation at lower rate for these sectors, so that they are, not to hamper the transition. So does that, Luis, also falls into your way of seeing a revisiting of the inflation framework?
I think we realized that the policy mix, let's forget about the trade wars and just think of a time where we are at the target, we are at 2%, but we are, as Elías was suggesting, with a clear view that we will be facing shocks that we can anticipate. Okay, so I guess in this sort of state of the world, obviously you will have to display a policy mix where fiscal policy will have to contribute to the financing of the investments needed for the transition. We had a section in our paper saying that, look, this would probably imply a change in the neutral rate in the economy. You will need more investment for the transition. And therefore, you can think of a situation where both monetary policy will have to sync the operations of an IT framework under the conditions that I described, which is either you believe that it's useful to have a escape clause, as Elías was suggesting, or an accommodation band, or perhaps even, this is an extreme step, a well-explained, well-documented higher center of the target. Remember, this was one of the ideas Olivier Blanchard put when we were rethinking the lower bound of monetary policy, not this kind of issue that we were discussing. In parallel to that, it seems obvious that the fiscal authorities will have to contribute to financing the transition and to financing research and development and to financing new technologies and also to financing transfers from developed countries to developing countries to engineer the change in their productive systems so that they can be participating in the transition to net zero with the limited resources that they have. So I don't see the discussion on climate and IT regimes in isolation from a discussion about what has to be done in a coordinated way between the community of central banks that work in the NGFS, they work at the BIS, they work in the G20, with also the ministers of finance that will have to understand what type of fiscal tax policies would be contributing to the transition on their side. And it has to be to finance the transition, it has to be to perhaps put a reasonable and efficient carbon pricing. It has to be on the research and development. It has to be on the balance sheet of multilateral banks or regional banks, development banks that can help to guarantee projects and investments for the transition. So it's a whole. What we are dealing here with in terms of the IT regime, it's part of the broader policy mix and the macroeconomic framework that we will have to adopt to be successful in the transition, in coordinating both developed countries, advanced economies with more resources, and developing countries that will have to be demanding more support and more financing from the advanced economies.
So we're close to the hour, but I would like to give you a last opportunity, Elías or Alexander, if you want to add something to the discussion, also on maybe on tools that central banks have in terms of monetary policy operation. Elías first, sorry.
No, very briefly, I want to second what Luis just said in terms of the interaction with fiscal policy. So, I mean, the first best policy here is to have fiscal instruments align the incentives of households with the speediest transition possible. And it would be great that if we could take that as given and then rethink our monetary policy frameworks. But again, we have an original sin in fiscal policy. I mean, budgets are incredibly stressed as they are, and without putting any considerations to climate change. This is just aging populations and the standard expenditures that they have. So unfortunately, I think we're going to have to take those as this original sin as a constraint. We will not see the first best policy, and we should take that as given. Coordinate with the fiscal policy, but basically take fiscal policy as given as it is, and then try to figure out what's the optimal monetary policy given those constraints that unfortunately we face at the outset.
So yes, I very much agree with what Elias and Luis just said. Maybe I can add to that. I think it is very important in this discussion to also ensure that we keep seeing the green transition first and foremost as in the realm of fiscal policy. And I think monetary policy should not try to engage with the green transition in devising new instruments, say different interest rates for different sectors in the economy, because that might ultimately lead to a dilution of the actual inflation target that we have. So I think that's maybe to add to what you said, very important that we really stick to the inflation target that we have. Of course, assist the green transition, but ultimately the green transition is in the responsibility of fiscal policy here.
Thank you very much. So I don't want to go over the hour. I just want to thank you a lot for this discussion. I mean, just this little hour shows how important the discussion should be in the future around the climate change and inflation targeting framework. I think it's only the beginning, and I hope that we will have many other occasions to talk about that. Before closing, I just need to remind the audience that the next webinar will take place on May 5th. It's going to be a Young Scholars webinar with Jasmin van der Straten, who will present a paper, Funding the Fittest, Pricing Climate Transition Risk in the Corporate Bond Market. Also, a more technical question that is also of interest of central bank, the price of risk in market in general. Thanks a lot to all, and have a nice end of the day for everyone.
Thank you.
Thank you. Bye.